As we check the boards right now, Opendoor Technologies Inc., trading under the ticker OPEN, is sitting at exactly $2.14 per share, marking a sharp 4.82% decline during this intraday session on heavy trading volume. The immediate reaction from most casual onlookers looking at their online investing apps is to assume this is just another standard volatile swing for a deeply troubled real estate sector. But the reality unfolding behind the scenes is far more calculated. What the broader market is missing right now is a massive, quiet shift in institutional positioning that began accelerating over the last 48 hours. While retail traders are panic selling on their individual brokerage accounts, large block orders are hitting the tape, indicating that major funds are using this specific drop to rebalance their exposure to digital real estate platforms. This creates an immediate curiosity loop for anyone tracking the stock market today, because the public narrative around Opendoor is focused entirely on high mortgage rates, while the internal mechanics of the company are quietly pivoting toward an asset-light marketplace model. It forces us to ask whether the market is pricing in a dying business when it should actually be pricing in a completely restructured software service. When you look at the general belief surrounding Opendoor stock, the expectation is simple and highly pessimistic. The consensus across major investing sites and retail forums is that Opendoor is a ticking bomb trapped in a high-interest rate environment where nobody wants to sell their home and nobody can afford to buy one. The common ground most investors share is the idea that iBuying, the process of purchasing homes directly from consumers and flipping them for a profit, is inherently broken when capital is no longer free. But challenging that belief requires looking directly at the data from recent trading sessions. Over the past week, we have seen an unusual divergence where Opendoor stock is experiencing elevated relative volume, frequently trading double its 20-day average, even on days without major press releases. This tells us that institutional liquidity providers are stepping in. If you pull up the Interactive Brokers platform or look at depth of market data on advanced systems, you can see large buy walls absorbing the selling pressure every time the stock inches close to the $2 psychological support level. This is not the behavior of a company heading towards zero. It is the behavior of a highly contested battleground asset, where expectations are completely decoupled from the current balance sheet reality. To truly understand what is happening right now, we have to look closely at the daily swings and macroeconomic pressures hitting the stock. The housing market is currently experiencing a severe inventory lock-in effect, which directly impacts Opendoor's ability to source cheap inventory. However, during the last few trading days, the sector momentum has shifted slightly as macroeconomic data hints at potential stabilization in long-term yields. When yields tick down even slightly, we see immediate aggressive short covering across the entire real estate tech space, causing Opendoor to experience sudden, violent upward spikes before settling back down as the shorts are cleared and the focus returns to macroeconomic fundamentals. This intraday volatility is a paradise for active traders using the Robinhood app or SoFi active investing platforms. But for long-term holders, it requires a deeper look at institutional activity. According to recent regulatory filings and volume tracking, systematic funds and quantitative trading desks have been increasing their options activity on Opendoor, particularly in out-of-the-money call options expiring over the next 3 months. This suggests that while the spot price looks weak today, sophisticated market participants are positioning for a sudden expansion in multiple. Let us pause for a moment to look at the broader ecosystem of online investment help and asset allocation. If you manage your money through a hands-off approach like Schwab Intelligent Portfolios or similar automated systems, a micro-cap high-beta stock like Opendoor rarely makes a significant appearance. But for those engaged in self-investing, this is exactly the type of asymmetric setup that demands attention. The sheer volume of shares changing hands daily shows that the market is actively trying to price a major transition. When we look at how this stock behaves compared to legacy giants or even broad sector instruments like Fidelity ETFs and Fidelity mutual funds, Opendoor moves with an entirely different energy. It reacts instantly to any shift in consumer confidence data or inflation metrics. If inflation numbers come in cooler than anticipated, Opendoor stock frequently surges by double digits in a single morning session, only to give back those gains if the broader indices face downward pressure later in the afternoon. This tells us that the stock is currently being treated as a pure macroeconomic proxy rather than being valued on its individual business metrics. At its core, Opendoor operates a digital platform designed to simplify the residential real estate transaction process. Historically, the company made its name through the traditional iBuying model, where they used proprietary algorithms to value a home, present an all-cash offer to the seller within days, take on the home as inventory, make minor renovations, and then list it back on the open market. It was an incredibly capital-intensive model that worked exceptionally well when interest rates were near zero and home prices were rising rapidly month over month. During that period, the company was growing at a breakneck pace, expanding into dozens of metropolitan markets across the United States. However, past performance records show that as soon as the macroeconomic environment shifted and borrowing costs surged, holding thousands of residential homes on a balance sheet became an immense liability. The cost of carrying that inventory eroded margins, forcing management to execute a massive strategic pivot. Today, the business model is shifting drastically toward a marketplace framework, connecting independent buyers and sellers directly through their technology stack, without Opendoor taking the physical real estate onto its own balance sheet, effectively mimicking a software-as-a-service model for housing transactions. This historical context is vital because it explains the massive tension between expectation and reality that we see on the charts today. The expectation, heavily influenced by older earnings reports and past losses, is that Opendoor will eventually run out of capital trying to maintain its old business model. The reality is that the company has significantly cleaned up its balance sheet, reduced its inventory risk, and focused heavily on high-margin partnership channels. They have integrated their services with top-tier real estate ecosystems, allowing them to capture fee-based revenue rather than relying on risky property appreciation. When you open up your Fidelity trading platform or track the asset through Robinhood Investments, you need to look beyond the net income line and focus specifically on the contribution margin per home sold. In recent quarters, even as total transaction volume declined, the contribution margin turned positive, showing that the homes they are turning over now are being managed with extreme pricing discipline. This is the exact opposite of what the general public believes when they glance at a simple stock chart and see a low single-digit share price. Let's drive some real engagement here because the community sentiment on this asset is incredibly divided. Comment below how many shares of Opendoor stock you currently hold in your portfolio, or share your target entry price if you are waiting on the sidelines. It's fascinating to see the split between people using a standard Robinhood stock trading account, who view this as a short-term lottery ticket, and serious analytical investors utilizing interactive brokers' trading tools, who view it as a structural turnaround play. Looking forward, the future outlook for Opendoor depends entirely on which version of reality wins the narrative battle over the next 12 to 18 months. There are two distinct scenarios that could unfold from this current $2.14 level. In the optimistic scenario, the Federal Reserve begins a sustained cycle of lowering benchmark interest rates, which would immediately unlock the frozen housing market. As millions of homeowners who are currently locked into ultra-low mortgage rates finally decide to move, the velocity of residential transactions will skyrocket. Under this catalyst, Opendoor's new asset-light marketplace model could scale exponentially without the company needing to take on billions of dollars in toxic debt to fund inventory. If this happens, the operating leverage inherent in their platform would kick in, driving substantial net profitability and forcing Wall Street analysts to aggressively upgrade the stock. Investors holding the asset inside a Fidelity brokerage account or SoFi investing account would likely see a rapid re-rating of the multiple as the market realizes Opendoor is no longer a capital-heavy home flipper but a high-margin digital broker. Conversely, the pessimistic scenario cannot be ignored. If inflation remains sticky and macroeconomic pressures force interest rates to stay higher for longer, the housing freeze will persist. In that environment, Opendoor will face prolonged downward pressure on transaction volumes. Even with an asset-light model, maintaining a complex digital infrastructure and national marketing presence requires significant cash flow. If the cash burn accelerates before the marketplace reaches critical mass,